Major funding for these broadcasts has been provided by grants from New York Community Bank, AmTrust Title Insurance Company, Perfect Building Maintenance, M&T Bank, Customers Bank, Marks Paneth LLP, Ariel Property Advisors, Sterling National Bank, Capital One Bank, Collins Building Services, Meridian Capital Group. Additional support has been provided by grants from AVR Realty Company, Amerant Bank, Bank of America Merrill Lynch, B6 Real Estate Advisors, Briarwood Organization, Chase Commercial Term Lending, Chase Commercial Mortgage, Citizens Bank, CPEX Real Estate Services, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handler Properties LLC, Handler Real Estate, Hodges Ward Elliott INC, Investors Bank, James D. Kuhn Real Estate Center at Syracuse University, Kilroy Architectural Windows, New York's Window Company, Matone Group, New Banks, Newmark Knight Frank, Optimum Window Manufacturing Corp., People's United Bank, Rockefeller Group, Rosewood Realty Services, SJP Properties, Stonehenge NYC, TD Bank, Terra CRG, the Merengoff Family Foundation, and these friends. So here we are. It's the third or fourth quarter of 2019. And you know what? Where's the market going? What assets are good? What do banks like to lend? So today I've assembled these four gentlemen, all under 40 years of age, to provide their insight on the state of the real estate market. My guests include Jason Richter, who is a principal at Capricorn Asset Management, Zach Redding, currently a director at B6 Real Estate Advisors, David Friedman, our banker, our money man over here, who's a senior vice president and regional executive for TD Bank. And last but not least, our principal at Crescent Heights, Casey Klein. Thank you for being here. Thank you. Let's put it in this way. You're more in retail, your specialty. You're in the investment sales in general. You're the money man, so you're the one who has all the decisions. And you're a combination. You're a developer and you're also in the capital markets. So how do you look at the market today?
Crescent, we're a national firm. We're anywhere from New York, Boston, to the West Coast, San Francisco, and LA. And I think what we're seeing is just a lot of capital out there, not so much bank being aggressive, but a lot of debt funds and whatnot propelling the cycle. So there's so much capital, whether it's chasing yields with the inversions. So everyone's chasing capital yield. So that's propelling where we are, whatever inning you want to give to see where things are. But the way we view it is, if you are properly leveraged and you take the focus like we do on the long term, I think it's a fine time to be doing things. However, you don't want to be caught.
You had some property over here in New York City over many years, but recently you had something in Tribeca and then you had something on the Upper East Side. How do you look at the market? Because certain investors are walking away from the market.
I mean, New York City.
There was an article in the Wall Street Journal talking about foreign investors are making a decision to walk away from the metro market.
I mean, New York's a very tough market today. I think politically, for us, it's very challenging, and it proves to be challenging. And I think that's having a dampening effect, whether it's SALT taxes hurting the for-sale market in New York City. I think the demand drivers from an international crowd from a geopolitical standpoint has changed the dynamic. So to invest today where costs are for development, it's just all these different factors give us pause and let us step back. We still love New York long term, but today to be an active investor, we're value-based. So we have to be prudent on the ongoing end.
Zach, what are you seeing? I mean, a lot happened on June 14th when the rental rules went into effect, which are having a major effect on investment. What are you seeing today?
Sure. As an eternal optimist, I try to keep my opinion to myself, but
Because you're also the youngest in the group.
sure, by a little bit. Transactional volume is down. We're expecting about 2,000 transactions this year, which is 2011 levels. Dollar volume is down. We're on pace to do about $34 billion in sales across the city in all asset classes, which is only down 6% from last year, but 56% from the peak. And then assets above $10 million are only...
Did you see what happened when you said 56% to the banker? The banker went...
Assets over $10 million are down 63% since the peak and 23% since last year. So that's interesting. And like you said, a big portion of this goes to what happened on June 14th with rent regulation. Multifamily is down about 42% over the year, but interestingly enough, mixed use is trading at all-time highs in terms of transactional volume. So we think that that's because retail is stabilized to a certain extent within the city, and the bid-ask component of things has kind of narrowed. And
since you've led that question to the retail expert, what's happened in the retail in New York City? How do you look at it?
Generally speaking, and I think contrary to the headlines, retail has stabilized. Over the last 3 years, you've seen significant decreases in high streets, Soho specifically, Madison Avenue, Times Square, probably to the tune of 30% on average. But
has Times Square seen a 30% reduction?
If not more so. I mean, those are average numbers. In certain instances, we've seen 50% reductions. I think there's a tremendous amount of activity and absorption as there's a little bit more of a, we'll say, the narrowing of that spread between bid and ask.
Sure.
So in Manhattan specifically, especially relative to capital markets, where some of the acquirers of 2014, 15, and 16 are now realizing, we'll say, capital events and having to restructure, I think that those fundamentals will continue where the bid-ask spread are more aligned. Those that ascribed pretty egregious numbers to their pro formas in those more aggressive times have had to come down, and the banks have had to let them and violate whatever covenants were previously existing in order for them to do deals. Because fundamentally, retail is always something where rents are substantiated by sales. If a retailer cannot perform, it just doesn't make sense. That's the one asset class that kind of works in that particular fundamental way. So an exception of the rule, maybe at Times Square, but every place else they have to be able to do business. So now that let's say the loans have either busted or there's a recapitalization, I think people have become a bit more realistic.
You know, the amount of hair on his head just got reduced when you said, when you brought up the topic of busted.
Not his loans.
You're a conservative Canadian bank, and the Canadian banks have done rather well during these recessions all the time. How does the bank today look at all the different asset classes?
Well, look, I think you have to have an established strategy that you adhere to when you see everything around you. To Casey's point about so many capital providers that aren't even bank, you can get wrapped up in chasing that. I think for us, with a well-defined strategy, a pretty outlined risk framework, we know how to maneuver and meet our origination and revenue growth within that framework. And that keeps us from having to chase to some leverage levels or geographies that would be at the edge for us or brand new for us. I think, look, at the end of the day, I think you really have to have courage in your conviction. If you know this is what you can do, this is what you want to do, you get it in. It's almost like a poker player. You defend your chips when you have the worst cards, and you get it all in when you have the best. And with it,
how often do you wear the sunglasses when you're playing that?
No, listen, I think, look, again, relationship lending, I think you have to be as transparent with your sponsors and your partners at all times. And I think, what's made TD successful before my start and since I've joined is we're very upfront with our sponsors what we can and cannot do. I think that's the message as I've talked to sponsors time and time again. When you tell them what you can do, those are the looks that you're constantly going to get. When you try and stretch and drag your internal process to areas and credits that are new, that adds time to the process, it creates uncertainty for sponsors, and that's where banks can get themselves somewhat tied up. And again, being relationship based, this isn't a let's get to the next cycle type strategy. This is, to your point, just like they did in 2007 and 8, they lent through that last cycle. It's no different this time around. We want to be there for our sponsors in the downturn and be even more meaningful to them on the opposite side.
When we're talking about New York City, many times people are too Manhattan-centric. Let's look at the opportunities in the other markets, okay? There's a lot of talk, especially because of transportation, especially because of the lower prices, that the Bronx. Have you as a entity, and there are certain major owners who have gone to the Bronx over there, have you looked at the Bronx as?
Yeah, we've actually spent a lot of time in the borough, and for a variety of reasons. I think the opportunity zone potential for us, we have a lot of capital that would benefit from an opportunity zone structure. We're not underwriting that. We don't know what happens with the opportunity zones, candidly, but that's interesting. But the proximity to Manhattan and the transportation is very interesting, and the big players that have taken a long view. So we're working on some major opportunities there right now, just over the bridges. And it poses interesting. I think the Bronx is a 10, 15-year plan, though. I think that is realistically what the Bronx needs to develop itself. I don't think it's one of these like Williamsburg, from 05 to today, right? I mean, I think there's a lot of infrastructure that has to get built, a lot of retail, a lot of curation.
You just said something interesting. It took Williamsburg probably 8 to 10 years, okay?
It's still on the come.
And it's still on the come.
Well, it's just growing. Williamsburg, now South Williamsburg, right, with what Spitzer's done and all that priming of that south area with Rose Plaza that's going to happen and Naftali. I think all that is elongating what Williamsburg was, right?
What about you in the Bronx as a bank?
Listen,
and you've had it from your career at the three banks, most of the time Bank of America.
Yeah, listen, I think the Bronx, to Casey's point, is definitely a compelling argument. Where we've found our spots there is really leveraging through our CRA business. Again, you think about yourself in the path of development, some of the blighted areas are going to get preferential treatment, and some of the in the areas in the Bronx have gotten that benefit.
Over the last 15 or 20 years, the Bronx has been a lot of CRA type of situation with the affordable housing because the land was cheaper, okay? And this is a place that you were able to build the combination, and then you were able to do the tax credits.
Yeah.
But I'm really talking today at the Bronx, looking at it in a twofold manner. Some of the Bronx is, right now there's some industrial being done in the Bronx. There's always been retail, which I'm going to ask Jason about in the Bronx. And then, now there's the new multifamily. My biggest question over there on the Bronx is, are these properties going to be able to get the $45 to $50 that certain of the people are expecting, while the reality is that the oldest stock in the Bronx is like $25 to $30 a foot?
Well, as a lender, I don't need $45 to get out, right? I will always take a haircut to the equities underwriting, but again, the mentality and the path of development, the new product, there's definitely a pent-up demand for that space. And I think what we've definitely experienced as people have left and moved out of the city into some of these other areas that have popped up and on the other sides of the river, the commute's not that big of a nuisance as it once was.
Right.
And I think, getting the infrastructure right probably will alleviate some of that pressure. And I think the other element of the, enterprises being able to be more flexible with work-life balance.
Yeah.
Some of these areas that, I don't want to be there, all of a sudden you don't have to be in the office 5 days a week, and you can do your job from your brand new luxury apartment with all the amenities and maybe a co-working space already in the building. It could serve as a great benefit.
Yeah, and I also
the
think
it's a luxury.
the positive momentum for the Bronx is the last mile industrial is going to be very impactful. I mean, Related was there many years ago next to Yankee Stadium with that retail project, and the multifamily. So all these different drivers, just because of proximity to Manhattan and also creating something within the Bronx, is very interesting.
It wasn't only Related. Joe Farkas was there with Metropolitan Realty Associates at the Stella Dora plant. There have been other...
Yeah, Taconic did the bank. No, I mean, there's a lot of things that...
Over the last...
There are a lot of things that have pockets of areas over the last 15 years that have had their own revitalizations. It's all coming together. So we're bullish. I mean, that's a part of the New York City metro market that we really like.
The industrial piece will be interesting because the concepts there, as we've seen packages come in, is multi-story industrial. And
Right.
just given the zoning and the density, that it clearly is a sort of newer product to the industrial space. It'd be interesting what that reception gets in that Bronx submarket as they're building those.
Zach?
B6 has a strong presence there. I personally am not so engaged in that market to speak very highly on it, but I have a good friend who's very closely involved with the Brookfield project there, and he is as bullish as I've ever seen anybody on a borough.
Retail expert?
I think it's a tale of two cities.
Fordham Road has always been strong.
Well, I was going to say, you have burgeoning neighborhoods, like the very south part, where luxury condos and residential are being built, and perhaps from a retail perspective, at the moment, it's more amenitized than anything else, food, fitness. But as you go north and you go west, I mean, East Fordham Road has always been and still remains one of the strongest retail corridors in the city. You've got rents right now that are basically peaking at around $200 a foot. And some of the the latest deals in the market include big retailers like Chick-fil-A, Capital One. You've got I'm not sure if it's signed right now, but a 30,000 square foot, very large scale user that we're all very familiar with that's opening up a mega store there. So I think East Fordham is as strong as it's ever been, if not more. And I think there are many other parts of the Bronx. But again, it's a very different market than the one we're talking about. That still is that $25 a foot reference on the residential side. That still is about density and affordable housing, and I don't really think the south part is going to change in that respect or impact that.
How do you look at the transit-oriented developments in Westchester? Because there are numerous in Scarsdale, Yonkers, New Rochelle.
Well, I think Westchester, applying to the Metro North lines and those commuting, the cost of living in New York City, people getting out of the city, wanting to get out of the city, even younger folks, because a lot of their rejuvenation of downtown New Rochelle, what Capelli started many years ago, and it's happening all the way south and north, frankly, with White Plains. It's anything on those lines could do very, very well.
People said, the developer said, even though you live near the transit-oriented development, you still need a car because you're there on the weekends. Okay?
But Michael, what's interesting is now I could go as a developer. We've done these deals with a company called Envoy. Envoy basically puts Teslas in my building at no cost to me, and people pay per use. And we've done this in LA. San Francisco.
So it's like the Uber.
So
Right.
So the millennial or the user today, even a family user, okay, they have a car at their disposal. No one needs a car. They have access to a car. They don't want to drive it. They get an Uber. So this generation with technology has been a great innovator of how to use it at a transit-oriented place where they don't need a car. And Jersey City has seen that, has been a huge beneficiary of that because of the challenges of cost in New York, and people just don't want to deal with it every day.
Since we have our Jersey resident who grew up in New Jersey, how do you look at the Jersey markets today?
I think, Jersey, you're talking about all the same markets, right? What's benefiting Westchester is probably benefiting the suburbs of New Jersey. I think there's still a desire for young families to transition out of the city into good schools or good school markets, homes. This whole suburban element is still making sense because it's this urbanization of these suburban areas, and Jersey sort of has been successful at that. It's still a function of transportation, and I think there's only so many arteries that can get you back into Manhattan from New Jersey, and hopefully there'll be another one somewhere down the road. But at some point, that pressure will be relieved as companies get a little more flexible with the work from home.
That brings up the interesting comment, which I think you have a specific interest on. Williamsburg, okay, the ferry. The ferry took it changed Williamsburg, okay? It really helped, even with the L train over there. The ferry is helping other areas today. John Catsimatidis hopes that it's going to help Coney Island. But you've seen that specific in Williamsburg.
I moved into Williamsburg in 2010. And I moved right outside of the ferry, and one of the reasons was obviously just the way to transport to the city. I mean, being above ground, having a view of Manhattan, back and forth, doing it efficiently, consistently, on time, it was the best quality of life commute that I've ever had. So I am a huge believer in wherever that ferry goes, whether it's Brooklyn, the South Bronx, New Jersey, and now even they're extending it to parts of Long Island where RXR has several developments. So,
Right, Garvey's Point.
right. So you've seen ridership increasing exponentially, including the outlets as well in Staten Island. So I think the waterways are in its infancy as far as its activation, and I think it truly is the best way to travel.
Yeah, I was with a prominent owner of office buildings yesterday, and he was saying he never expected to see office rents in a triple digit in his lifetime. The office market today, for the large user is spending a lot of money because they need the space, and they're seeing over $100 a foot. What's your thoughts about the office market?
But there's the new stock. I mean, New York historically has been old stock, right?
I'm talking about the new stock.
So the new stock is a lot more efficient. So maybe the chunk prices are a lot higher, but the efficiency of the space is just so much better. So that's why I think Hudson Yards and what's happening on the west side between Brookfield and others, they're getting these rents because the companies are saying, and their advisors are saying, hey, you pay these dollar rents, but look at your footprint and how efficient it is.
And you're getting more space.
And you're getting more space, and it's not, and we're not.
You don't have the loss
and
factors
yeah.
as you
Well,
had
that's the thing.
before.
I think you look, the headline number at triple digits, great. Multiplied over the square footage,
Yeah.
and then compare to what they're currently paying, or
Right.
what. Then it kind of
Right, the efficiency levels.
it smooths it out. I mean, we've got some buildings that we've lent to that are new product. Tenants that are coming in are moving over with 70% of the space that they're currently in. So there's a real cost factor.
Okay,
saving.
with regard to the office, what's anybody's view of the WeWork world and the co-working?
Aren't they in the quiet period right now?
They're in the quiet period, but
should we be in
we're
the
not in the quiet period.
But
I'd
I'd really defer to the lender here.
I-
How he looks
I-
at the credit beyond that, and how you look to
I'm
lend.
not only talking about WeWork. I'm talking about Industrious. I'm talking about Convene. I'm talking about Notel.
Regis.
Spacious was just acquired by WeWork.
I think the majority of the traditional banking market has determined to limit their exposure in any one given building with WeWork to somewhere between 25 and 30%. That was sort of the way it was established 4 or 5 years ago. I think we are going to be in the infancy of understanding that credit now with the S1 filed, and now really digging in. Sam Zell was on Squawk Box this morning and had some compelling
I heard Sam a
arguments.
couple of months ago. He said
Sam never does that.
I hadn't heard him on there, but I heard him publicly at the University Club a couple of months ago, and his opinion, he hated it.
From a banking perspective, the credit is one thing to look at, but then I think as we think about this market, they've effectively become the largest landlord in the city.
Yeah.
And
They
I
are the
think
largest.
and I think that, as a banker, is somewhat concerning.
Right.
Because you're now, while you are putting your faith in, the institutional names, the public REITs that have been doing this for year in, year out, you're now really subjected to a company that is making an option play on that space and taking some of the resolve out of the hands of those that have been doing it for a much longer period.
What about your thoughts about co-working in the retail spectrum?
Yeah, adaptive reuse of some sort always, makes sense depending on the market. My general sense is that co-working has been around for a long time. Regis has been
Regis has
around
been for 30 years.
Exactly. And
there have been plenty of other co-working companies.
And if you go back 20 years ago, Regis also got into a little bit of trouble during that time. It is nowhere near the size of what it is today. But the only fundamental shift that I think I would mention is that entrepreneurship has been on the rise since the recession and has created a whole new generation, especially with these millennials and the rest. So I think there's more a need for it than ever, and you and I in particular have utilized it ourselves in some respect or another for growing companies. But the credit risk profile alone is something I think that is quite scary.
One last comment. Co-living. Thoughts, comments?
I co-live with my wife.
I think everything you're seeing today, co-working, co-living, et cetera.
You're 28. What's your thoughts of co-living? You're the...
I would not live in a co-living space. It's not for me. But I think that all of these prop tech, or trying to prove themselves as tech companies are going back to fundamentals, right? And that's important to note. But I also, just back on WeWork, if I can, very quickly, I heard an interesting thing that they're always trying to say that they're a tech company and that their EBITDA and their multiple is more than a traditional company would be. And basically that's because of the data that they're collecting on every individual user within the space, which could be very interesting if true. It's like they see where your food orders are coming from, how often you're ordering them, when you go to the printer, all these different things. And I think the behavioral...
Very Uber-like, but yeah. I think, if you look to have a liability schedule that a WeWork does, or any of these other operators do, and then get a tech multiple, it's, look at what's happened to tech companies over the years.
Sure.
There's been great successes and great failures. So I just think that's such a mismatch in value. And also I think it's very incumbent, we'll see how a WeWork or an Industrious, who I think is a great company actually.
I do too.
And I think has the right fundamental on an enterprise client perspective. I think those are those stories will prove itself out over the next couple of years and whatnot.
I wish we had more time, and hopefully in a couple of months we'll do it again. But I'd like to thank my group of 4 under 40 for your perspective on the market. My guests, Jason, Zach, David, and Casey. See you next week.
Thank you.
Thank you.